All right, everybody. Good afternoon. Welcome back to the Opportunistic Trader. It's about 1:30 on October 25th. I believe today is the most active options day of the quarter. And with that, we have some major names as well as some other names that maybe are off the beaten path. But we're joined by Tom McEntee, who's going to be breaking down a lot of different opportunities in some of these names to have you ready for after the close. How's it going, Tom?
Very good, Mike. Thank you. Hope you guys are doing well.
Yeah. Active day. Obviously, volatility pretty wild yesterday, and then some individual names today. I think they said is going to be the most active day of the quarter. So a lot of things to get to, a lot of opportunities out there, and I was wondering what's on the radar.
Okay, let's just because I think there's some pressing interest in this. I think Gabe B wanted to do something at Amazon, and I'll oblige him. I looked at Amazon. If you're familiar with my process, it's like I go back 8 quarters. I look for the extreme move in the tenor that I'm long or short. If I'm long, if so I'm doing tomorrow options in Amazon, options that expire tomorrow. So obviously, it's the most binary it could possibly be. So I want to look for the extreme 1 day move up or down in Amazon post earnings. And that has been 6.1% in the last 8 quarters. Interestingly enough, 7 of the 8 quarters it has reported 7 or less. So there was an outlier in there a couple of maybe 4 quarters ago where it was a 15% mover. But by and large, it's been about a 7% or less mover 1 day post earnings. And obviously, I think the straddle the last time I looked was implying it was about it was about a 6.4% move. That's what it was implying. So let's just play that. I think what's interesting here is from a technical perspective is that if we look at Amazon,
It's $100 basically.
that's $100. That's correct. And I want to look at that.
200.
Yesterday's low was, I think, if I'm not mistaken, was it 16? I'm looking at a low from
I'm
16.
showing the low today is 1692.
Okay, I have the
Oh, I
thing
could
up.
pull it up. Hang on.
I got it on my other screen up. I can't do two things at once. You realize that, right? I got to go to another screen, hit up Amazon, hit up a full chart.
Yeah, we got
And
down into about 1650.
yeah, that was my number. 1656. Does
55
that
ish.
sound right?
Yeah, 56.
Okay. All right. Now that was from how long ago was that?
Ah, nothing. It was 24 hours ago. So let's
That
start
was
out with.
yesterday, right?
Yeah,
1656.
of
Okay.
course. Yeah, no, it was, yeah,
Okay.
literally it
Yeah, I
was
know. I know. I
24
write.
hours ago.
I got like 5 legal pads in front of me. I just write numbers down all over. So I don't know what I mean. I'll give you 1656 could be the price of Mattel. I have no idea. Amazon, but there'd be a decimal point in there somewhere. I think between the 6 and the 5. Yeah, Amazon. The recent low was 1656 yesterday. I think the all-time high is 2050, give or take. Is that about right? Yeah, 2050. Okay, I'm looking at that midpoint, so that's 1850, 1656, 200. That's
Holy cow.
394.
I'm just looking at some of these puts right here. Sorry to interrupt with a holy cow,
Go right
but
ahead.
1630 puts for tomorrow expiration. Let me make sure I was right there. Yeah, tomorrow expiration 1630 puts are $13.
Yeah, hey, well, you know what? I mean, there's some real tail. There is some real tail concern out there, and I mean, I
Eight,
guess it's warranted, obviously.
1850 calls are $16. I mean, 1900 calls are $7. 1900 calls. That would put it higher than that would put us about 3 weeks ago.
Right. Well, but what's interesting, I think Henry Schwartz, an old friend of mine, haven't seen him in about 25 or 30 years. Great guy. He
Yeah,
was on
I
before.
did you listen to him earlier?
Yeah, he said I thought I could have been hallucinating. I haven't done LSD in about 35 years, but
I saw your comment.
I thought he said crash up. I just wanted to clarify that.
Yeah,
I
that's
thought
what
I was
that's
having
what the
a flashback.
volatility that we've been in over the past 2 days has people talking about crashes higher.
We're not worried about a crash up. I'm like, what? What did he just say? Okay. Anyway, so I think it's important to look, and I think Henry alluded to it, but even if he didn't, it bears perhaps underlining. I think what's important, like this is Amazon's typical. And Henry was talking about the same thing I've been talking about ad infinitum for this 2 or 3 months. Variant stuff is based off 25 delta put over 25 delta call. Now you see it in Amazon. That average spread over the last 52 weeks has been 2.2. Now, I would go a little bit further because you want to maintain, the relationship is it's 2.2 on an at the money vol of, as you see here, 28 point. You can see all this, right? Of 28.2. All right. So that so 2.2 on 28.2 is about 7% roughly, give or take. It would be about 7% Okay, so I'm just saying the variance spread is about 7% of at the money vol. Now today, interestingly enough, obviously, you got earnings, so you got that binary type of deal, and plus you have turbulence in the market. That PC rate, that put call ratios now is 5.4 on a 45, so it's roughly about 9%. So you see, it's inflated on both an absolute basis and on a relative basis. So you got to be cognizant of that. So that's definite. There's definite some type of fear in the marketplace, and like I've said for a while, it's certainly warranted. But so I think you want to avail yourself of that. So I would structure something in Amazon to play that right now. So what I would think is that recent low 1656, that was all the way yesterday. You said that, Mike?
All the way to 22 hours ago.
So I guess the high was, I think what was the high? 2050, and that's like 5-6 weeks ago, right? What was it? 9.7, something like that. Right here, 9.04. So that's about 6-7 weeks
ago. The amazing thing about Amazon, I just pulled up a chart. The 2-day price action yesterday was a huge down day. I mean, we're down like $10 in Amazon in 2 days.
Well, that's probably a little silly. So that's a great point right there. That's a real good point. To keep that and Apple, right? It just seems like all the money's hiding there. Apple
and not hurt right there. Well, it goes to show you with all the volatility that Apple and Amazon still are, right there. These other names are just getting killed. If you don't have Apple and Amazon, you are just getting crushed.
Right. So, I mean, the point being, you want to be a contrarian because everyone thinks alike, no one's thinking. So, I would say that if they're wrong, I mean, Amazon, you got shaken up, right? I mean, you came in close to 20% off the three. You did come in 20% off the top, right? 400 points is 20%, but you're down 350, 17% off the top in 6 weeks. So you've had that correction there. Apple has just defied everything. I've been in the chat. I sold the thing around 220. 221 spot 89. I've been looking, and I finally did buy Facebook on some crazy option spread yesterday against it because I want to be part of the complete I believe in the complete jackass trade because Larry knows what that's about. Do something that only a complete jackass would do. It usually works. I want to be long Facebook and short Apple just because I just think everyone's on the same side of this trade. Everyone's long Apple, and God forbid they're wrong next week. Anyway, so back to Amazon. I think it's had its haircut. I think you can leverage 1656 low, 2050 high. The midpoint would be what, 53? Am I right? Yeah. 194, right? What's it? That's 394, 197. That gives you 53, right? 1853. Let's leverage that line. Interesting enough, I think we got up to that 1850 level a couple of days. That is the late. I use terms like here. Look at the high from 1017. I want to share my page. How do I do this? Look at the high, guys, from 1017 in Amazon. That was 1845. I would call that the last high before the last low. I mean, for lack of a better freaking thing. I mean, it was a rebound high off about the 1700 level. I'm sorry, off about the 1685 level. Got to 1845. I think on what was that date? That was 1017. So that's a week ago. 1845 got rejected and came in. So I think leveraging that line is, that's one line that proved to be, rather formidable resistance. And I think 1853 being the midpoint of this 1656, 2050 range. I think I want to look to sell in there. I'll sell some calls up in there and protect myself with next week's stuff. Okay. Now to that, and also, I can do this two ways. I am kind of agnostic about direction here. I think it's probably, maybe the upside's done. And to your point, and that's a great freaking point, Mike, is that it's almost unched for the 2 days. And the S&Ps are down. What are the S&Ps down? About 40 handles in 2 days, ballpark? Where are we trading?
More than that, I think. Oh, no, yeah, I guess not. We're up 40 today. Yeah, about that.
Yeah, so they're down 40 handles. Nothing. And this is unched.
We've actually taken back most of yesterday.
Yeah. So I want to sell in Amazon. My trade is this, and I'll put it in the chat. I want to sell the 1845 call. I want to get, I realize with the stock trading here, maybe 5% higher is 85, is 87, is about 87. I'm selling about 5.5% higher. I want to sell that 1845 line. I kind of think that I don't know how aggressive people are going to be above that, but obviously there's no accounting for taste and some other things. But I mean, I want to sell that 1845 line, and I want to play it close to the vest on the put side, and sell a downside put, sell a 1642.5 put. These are all expiring tomorrow, and to protect myself, I'm going to buy next week Nov 2. I mean, it would be helpful if I put these things up, obviously, right? This is what I'm selling. I'm selling the. Sorry about this. Okay, I want to sell the 1642 put. That's about 1650. I want to sell the 1845 call. Figure $17. That's $33.50. And to protect myself, I go out to next week. I go out to November 2nd. November 2nd. I want to buy the 1867.5 call. I picked these strikes. I didn't pick these strikes out of the freaking out of the ozone layer. And I'm going to see Commander Cody next week. I didn't pick these strikes out of the ozone layer, but I want to buy the 1867.5 call and the 1600 put. And for all that, my net debit's going to be $5.75. I'm bidding for it. I'll play that spread myself. I'll bid $5.75. My break evens in that tomorrow, and I'm knocking volatility down. I'm going to knock volatility down to 27, which is extremely aggressive. But if I'm long it, I want to look at worst case scenario. So I'm going to knock down, like if you look here, this is November 2nd stuff. It's trading at about a 62 vol. All right. Typically, I want to look at volatility. I think this is where I want to knock volatility. This whole thing started right in here. I mean, this was the low in volatility was 26 back on September 19 in Amazon before this whole move started. I'll say that the earnings are so freaking good and they placate everyone and all the fears are allayed. I'll knock volatility down to about that level, 27. So I'm going to take the worst of it. And even on an up move, and even on that, I have break evens up to 1865. Okay. And then on the downside, I got to, so if the earnings disappoint and we trade in the 1600s again, volatility is going to be somewhere around, my number is 37. Once again, I'm being aggressive, knocking it down because I'm going to be long it. I want to see, what's worst case scenario. And I'm going to tighten up my break evens by doing this, but that's fine. I'm going to use a 37 vol. So this gives me break even between 1635 and 1865. Now, what we should, so 1635 to 1865, 575 debit, that's strangle swap. Number one, it's an $1,800 stock. It's not a $180 stock. It's not an $18 stock. It's an $1,800 stock. So you got to size it up accordingly. You want to use a 40 volatility on this thing. So you do it's 1,800 times 4 times 0.4 is 720. The spiders are figuring a 20 vol is 54. So that's roughly about, you should be about 1/14 your spider size on this thing right now. So if you're a 50 lot guy in the spiders, it's a 3 lot here. All right. I mean, and I'm not going to, you might even be as low as a 2 lot because you got to be cognizant of that. These are real dollars you're playing with. And it's a $2,000 stock. So size it accordingly. Just because you're a 50 lot guy in the spiders, you're not playing. You can't it doesn't automatically translate to a 10 lot in Amazon. I would say it's somewhere between 2 and 3, but do whatever you got to do. But be cognizant of your risk. That's you got plenty of room. You got 1635 to 1865. And now what I think is going to happen here, and I think why I want to own next week is I do some proprietary studies using average true range, 5-day average true range, and a 10-day historical volatility in SPX. And I've come up with this thing where I leverage it against a 21-day moving average, and I come up with a number. And the number is 18. And it's amazing how when I get that reading, I got 18 last Thursday. And that is sticky. I got 26 yesterday. I haven't seen that since August of 2015. So the contrarian me says you want to sell volatility, and I'll pick my spots because I think I can trade around it fairly well. I think I can almost. But I want to buy. But I think it's important. I think you want to avail yourself of it if it comes in. You're not going to buy VIX. You're not going to get You're not going to get Spider Vol at 10 anytime soon. I don't think. So I think you got to pick your spots when they start to sell it. If they keep running them up today and it's a fire sale on a Thursday afternoon, I think you got to stick your toe in the water, and you ain't getting the bottom. But I think you want to avail yourself of it and be able to leverage it, hopefully tomorrow, next week, or whatever. Because I don't think this is over by a long shot. Okay, so that's Amazon. Okay, the next one I want to talk about, Mike, is Intel. And let's put that up. Where is Intel? Intel. Okay. Now this one here is really. This one's really kind of simple here. Intel. Where's my chart? Hold on one sec. All right, NTC. Okay, Intel. Last 8 quarters, it's been a 6% mover. You had 2 outliers, 2 11% mover. Now, obviously, these are extremes. 6% mover on average the last 8 quarters. This is 1 day later. 5 out of 8 have been less than or equal to 5. I want to look at the recent the recovery high here from about 3 weeks ago, 10-3, 49.72. Yesterday's low, 42.36. $7.36, $3. The midpoint of that is 368. Puts me up at 46.04. A gap filler would be 46.54. Do you see the gap from 10.9 and 10.10? 46.54 to, I guess it recovered as high as 46.33. So I want to leverage that 46.04 midpoint thing. I think the thing's probably, you may get a pop in it. I think I want to leverage that. I think it's a real cheap way to play. I don't want to say the ball's halfway down in the basket. I'll just freaking jinx myself. But the trade I put in the chat is this. I think I like this next week is the November 2nd. I want to buy the November. What did I put in here? It is I want to buy next week's 47s. They're currently trading at about 50 cents, I think I see here on this thing. Against this week's 46 and a half. Well, against this week's 46 and a half. Against this week's 46s, my bad. I want to buy next week's 47, sell this week's 46s. I'm looking for a when did I get filled on that thing? Hold on one second. Let me just see what I'm doing there. I'm buying the no 47s, selling the no 46s, 7-cent credit, right? Am I doing that right? Oh, 47.50. Yeah, that's what I want to buy November 40. I put it in the chat wrong. November, next week's 47s. Sell this week's 46s. Tomorrow, 46s. 2-cent credit. I'm sorry, 7-cent credit my way. Okay, it's usually, I think it's about a nickel bid or something like that. So if the stock rallies, we'll get it. I got a break even up around 48.10. This is a real good spread. Real good spread because you got, look, the thing goes to, the stock trades down at 12 tonight. I mean, it's a rip up. you pocket your 7 cents, but you got room up to 48.10 on the upside tomorrow, and I'm knocking volatility down to 27. So, it's important to relate that you always got to look at where volatility is going to be, not where it is right now. Where volatility historically has resided post earnings. Now, I think now it might be I hate that expression. This time it's different, but in this type of turbulence you're having right now, and I think that's obviously global and not just specific to a couple of stocks or a specific sector. I think that volatility is probably going to hang in there, and like I said, that reference, that study I usually do, it's kind of persistent and kind of sticky once it gets up in there. So the Intel next week 47, tomorrow 46, call spread 07 credit. Do it for nickel credit. That's a good spread. You're leveraging those technicals. I think if you do get a rally, I think the stock's probably going to be heavy around between 46 and 46 and a half, and then you got a game next week, which I think if it trades above 46 and a half, you're going to be long those puts. Long puts $3 higher from here or $4 up below isn't the worst thing in the world. So I think I like the Intel thing. I think also what we should, it's important here. What I see here is I want to show you guys a chart, and this is more of a global type thing. I look at this a lot. I want to compare this. I'm going to try and share my screen with something else now. Let me see if I can do this. If I can actually pull this off. New share. I'm over here. Okay, do you see that chart now? Let me see.
No, I still see the intel on Chameleon.
There you
we
go.
go. Yeah.
How's that? Okay. Now, this is a chart of VIX against VXV. VXV is 3-month vol. It's a 3-month volatility index. VIX obviously being a 30-day type deal. Okay. Now notice here that on 10/10, what's that? 2 weeks ago, VIX is the solid, whatever that gray line, solid gray line. VIX was trading over VXV, and it really, and it has sustained that. Okay. VXV is the blue line. Okay. Everyone got that? You see that, Mike?
Yep.
Okay, cool. So now VIX, short-term vol over VXV. And obviously that translates into the futures curve in VIX, in VIX futures, right? It's all backwardated right now. And indeed the same thing across the SPX curve. Everything's backwardated. Now, notice, I think you were talking about it, Henry was talking about it. I do a lot of VIX studies. Of VIX, yesterday's VIX of like, what was it? It closed 25-ish, I think, 24, I forget. It closed 24. What did it close yesterday? 25.20. That's a historically very low close for a 3% SPX decline day. So I don't know what that means. I'm just a point of fact. Now here, this is interesting. Here is VIX back in February. Okay, you had VIX trading as high as 38.8. I'm sorry, high as 50.3, with VXV trading at what was VXV? Closed down around 23 against 33. So the thing was about 1.5x. And notice how that's sustained. But since April 2nd, I guess, was the last time this thing inflated and had some type of persistence where it stayed there for a while. The VIX has been contained below VXV, and that's why you have contango in the vol futures curve, the VIX futures curve, and contango in SPX options. But I think this is interesting here, and I think we all got to be cognizant. I think you are, but I think it's important to reiterate that it's nowhere near as extended as it got back in February. Now, that could be the collapse of a volatility product back in February, and that I'm sure that contributed something to do with it. Plus, we're coming out of an incredibly dormant volatility period there. Ever since the election, the market was pretty much just marching higher every day, with VIX just grinding, with volatility just grinding inexorably lower. So now what you have here is, I think to my study there, that 18 number and average true range and 10-day historical volatility, blah blah blah, that thing sticks around. It sticks around for 20 days. So I'd be cognizant of that. And I just got to say, I think if you get a chance to buy volatility on rallies, whatever, on rallies in the underlying index of stock, I think you want to avail yourself of it. Spread them, do whatever you got to do. But I think it's there to be capitalized, because we always speak about this. We spoke about it last week. I'm not looking to buy a call option at $1 to sell it at $1.20. I don't care about that. I want to buy a call option at $1 and sell a 200. Well, I can't do that anymore. Sell a $270 stock and control it that way. Utility of gamma. Period. That's all you want to do. So you could have had puts this week. You had so many. How many two-way goes did you have in this thing? You got 268, 274, 265 in a day and a half. Extreme. But you can eat a lot of volatility for a long time before you give that back. So that's all I'm going to say there. We covered Intel. We covered Amazon. Okay, what else you got for me?
I was talking with Henry about it. Tell me, bring up the chart of Gilead, GILD. Yeah, they have earnings after the bell. Let's take a look at that one. I'm interested in, what you think we might be able to structure there. Completely zero view whatsoever on up, down. I'm just wondering, based on that, are there some sort of spreads that look attractive?
Sure, absolutely. Good question. GILD. I'm going to move my. Look at this, Mike. I am just. You know what, Mike? I'm just moving seamlessly from screen to screen. Hasn't hit up yet. Let's say.
You jinxed it, man.
I know. You know what? That's why you never freaking talk.
I have another topic to get to in a minute after Gilead that's right up your alley that I just thought about.
It's like James Conn and the Gambler. They don't pay off winners at halftime, Axel. Okay, Gilead. Yeah, all right. All right. First thing I look at here. This is getting inside. You're able to peer into the you're able to peer into the mind of a madman right now. Here we go. All right, Gilead. Now these are all the earnings. I go back 8 quarters. Why? I have no idea. And this is what I'm looking at. Now I don't want to touch it because that screen will disappear. That little small pop-up screen will disappear. I look at, hey, last time they reported July 25 after the close. Well, the stock was $79, got as low as 76. $3, about 4% move, right? That's about 4.5, whatever. We'll say $3. Here, we go back another day, 72.56 down to 66, $6.112 is about 8%. Here we go, Feb 6, 80 spot 38, got as high as 84, figured $4, 5%. October 26, 77.88, went down $6, the low is 72.76, figure $6, that's about, we'll say 8%. Over here, July 26, I got a close of 74.19, got as high as $5.99, $1.80 on 74, we'll say that's 2%. And 68.59 down 241, that's about 3%. That's how many quarters? That's 6. Here, 73.13 down about $7.50, we'll say that's 10%. 1, 2, 3, 4, 5, 6, 7, 8, one more. And right here, November of 2016, 74.07 down $1.50, about 2%. So I get 4, 8, 12, 17, 25, 27, 30, 42 divided by 8, 5.4% move. And the implied straddle is 5.6. So you've had an average of 5.4%. But I like to pull out the outliers. So out of those 8 quarters, 1, 2, 3, 4, 5 of the 8 have been less than or equal to 5%. So we might be able to leverage that 5%. Now watch this, Mike. I'm not going to say a word. I'm just going to see if I can do this and have it just magically pop up on my phone and your screen. And this will make it all. Look at that, huh? You're amazed. You're speechless right now. Here's Gilead. What's this low here? Interesting. 60. I guess I got low 64.27. I just want to leverage everything with the. Yeah, I think we're in this period. I mean, I think you got 76.44. This low yesterday was 67.25. So what's that? $9, 450, 71.70. 71.70. Okay, so I want to see. Let's see here. 71.70. A 5% move would put this thing. See, I think you can probably. Here's what I'll say. I think you want to. Geez, what's that 11? I mean, I think you can probably leverage this 72 line here. Tomorrow's 72s. I mean, a 5% move in this thing would be 350, put about $73, right? But I think you can leverage that 72 midpoint. I think things are going to be. I would be surprised, and it wouldn't be the first time, obviously, if it got through that level, with any type of conviction in this environment right now. I mean, obviously things can change, but I would say I would sell this 72 line. Now, right there, it's about a 34 delta, right? It's about $1. We'll call it $1 for argument's sake.
You're saying the 72 or the 73?
72. I want to sell the.
Which is about 85 cents right here.
That's about 85 cents. Where are next week's 73 HIBs?
Next week, 73 half calls. I'm showing strangely 83 at 94.
Yeah, something like I bid a nickel for that thing. I buy next week's 73 halves, sell this week's 72s, pay a nickel. Look, you're losing
that.
The stock.
Okay, hang on. So if you said selling this week, buying next week, and
Correct.
You're paying a nickel. So if your risk is we go up and then the market sells off after that.
Well, I have no risk on the downside, obviously.
No, but you have risk, though, if, let's say, take me through this. Let's say we trade 73 today. I'm sorry, tomorrow. Let's say we trade 73 tomorrow.
Okay.
You're short the calls. And then if we go down after next week, basically. You're long the 73 and a half calls, which would obviously go up if, we're trading 73 tomorrow.
Right. Okay. Here's what I'll show you. This is what I'm going to do. Here. I trade at 73 tomorrow.
Yeah. What would you
72s
do?
I'm short. Those 72s I'm short. Well, now I'm short the stock, right? I mean, they're worth $1, right? Intrinsically, that's what they're worth. They're worth $1. Right. So I want to say, hey, where is vol? This is a volatility curve here. Here, this is 27. This thing was 19 volatility. Currently, obviously, its earnings inflated. I mean, I'm going to say, does vol come into 30? Does vol come into 26? I'll knock volatility down to 26. I don't care. I mean, I'll just say I'm freaking dead wrong. Vol's going to be 26 next week.
Right, but my question is, how do you react to this position that you have the weak spread on here? How do you react once you're, if they move higher and you're exercised into the position, then what's your next move?
My next move is I'll play it out. Now I'm long that put, right? We go to 73. At 26 vol, I'm still ahead of the game. I'm making it dime. Okay, I'm going to lose around 73 and a half, 73 spot 60. That's what I need to lose on. Okay, so at 73, it's 73. Okay, now I'm long next week's 73 call. I'm short stock. I got that put. If I'm nervous on Monday morning, I can sell the put, or I can buy the stock and just unwind it. All right, I'm a synthetic long call short. Long call short stock is long. That's what that structure is. So that's how I would do. I did the same thing in Express. I had an Express. I was long the 106 calendar. The stock closed above 106 last week. You can look at it. It's all in the chat from Monday. Like I got that move down Monday. I sold the 10. I think I paid whatever. I paid like 17 cents or 32 cents for a 106 call spread. And Express stock closed 6 1/4, give or take. And I think I wound up Monday morning. I get a move down. I sell the 04 puts at 48 cents. Obviously, a little too hasty. In hindsight, being 2020, a little too hasty. I could have got about $1. Could have got about $1.50 more for those at least. But so now I own that. I own the 6-4 put spread I pay 17 for the 6 puts. Think about it. I pay 17 for the 6 puts. That's what I did. I bought the 6 calls of this week, so the 6 calls of last week. Stock closes 6 1/4. Well, now I'm short stock, long call. I paid 17 cents. That is, in effect, is my net debit for the puts, for a synthetic put. So I own a synthetic 106, or I own the synthetic 106 put for 17 cents. But I sell the 4 puts at 48 cents. So now I own the calls. I own the put spread, the 6-4 put spread for a 31-cent credit. 17 debit, 48 credit, 31-cent credit. I mean, that spread will probably go out at like $2. Well, it looks that way.
Right.
Anyway.
All right.
Okay. So the same principles apply here. That's it. So Gilead, I'll be long that put. I'll have that synthetic 73 put on. Now I got a gain. I don't mind that at all. That's fine. 73, anything up to 73 and a half, I'm good.
Right.
Obviously the optimal thing is 72, right? The 72s go out worthless, and my the ones I'm long are worth about 63 cents. I mean, you're doing it for, you're doing it for a nickel. What do they want to do for a nickel credit? I mean, you're going to make 63 cents. I mean, these are multiples of X. That's a good spread. If we go down, we go down. You pocket the nickel. On to the next one.
Yeah. And on that, one last stock, Sunil is popping up in the chat, and he's asking, Tom, Tesla, I know earnings were yesterday, but do you see an opportunity for a short play here?
Yes. That's funny.
I think there are a few thousand people that see an opportunity for a short play and saw an opportunity for a short play.
That's true. Unfortunately, I saw an opportunity for a short play at the 279 level. Right. So
you're not alone.
That's not working too well. So in Tesla, full disclosure, I'm short 279. I sold 316 this morning. So what does that make me? 37.18. 290. Is that a 297? I guess. So I'm short at like 297 on average. You know what? I think it's interesting, and that's a great. I will bring this up in a second. Good question, Sunil. Here is once again. Let's go back to this. This is Tesla's. Remember, Mike, you and I talk, once, twice a week now for the better part of 2 months, and this is what we're always talking about. This. Do I have the right thing on? Do you see that? Yes. Okay.
Yeah.
I'm going too fast. This is the put call. This is the put call spread. We'll just call it the variance spread in Tesla over the last 52 weeks. Right? We've been talking about this, and we've been talking about how you can sell the downside put and buy the upside call. And you can do it delta neutral. You can do a one. You can do a one up. However you want to fashion it, it's there, and there's a lot of vol to scrape out because the downside was blown up, right? And we knew that. So anyway, for the last 52 weeks, the average put call, the variance put call spread has been about 7.7%. Okay, on as we see over here, a 48 volatility, right? So that's about what is that about 15% roughly? Right, 7.7 divided by 40, about 15 and change, 15.5%, 15.6%. Okay, now it's Now today it's still somewhat inflated. It's about 15%. Now today it's 11 it's 11 against about a 61. That's about 18%. Now look what it was like. This is what was October 22nd? Was that Tuesday? That was Monday, right? Monday it was 20%. What you're seeing here now is, I think the put buyers have been burned. The tail buyers in Tesla have been burned. There's no question about it. I mean, they may tell you they bought stock or whatever, but I don't buy that. The tail buyers have been burned. They've been bidding this stuff up. Now look here. This is a 25 delta put in Tesla. 67 vol. Hasn't been that cheap since October 3rd. I mean, it got as high as 93. I mean, this stuff was blown up. This spread was trading as high as 19.3. Now it's 11. Now, I think on the short side, yes. You know what I want to do? I think on any pullback here or on a rally here, I would set myself up to buy some upside calls and sell stock. I think this 315 level, this 316 level is a midpoint. I think the stock's made an incredible move in a real short period of time. So I think if I could sell stock around 316 and buy some upside calls, I'd go out a little bit, go out to November maybe, and try. And if you get and look, volatility is starting to come in here, right? Here's 25 delta call. Look, I know earnings are out, but it's 56. Hasn't been this low since October 3rd. So I think, now watch it. I'm going to see. I'm going to really impress you here, Mike, when I do this. This is going to be something special. Boom. I want to hit up Tesla. Boom. Just clicking like a madman. Okay, now you see Tesla here. Did I get over there? Oh, this is it. Okay, here's Tesla full chart. Okay, let's look where we were on October 3rd. Where was the stock on October 3rd? Boom, boom, boom. Right in here. Got as high as 304.60. This is where we were on October 3rd before we made that move down to 252. So yeah, I think you can leverage this 315 line. You know, I buy call, sell even right in here. Where are we now? 310-ish? Is that where we are roughly? Yeah, something like that. We're trading 310 right now. I buy the upside. I buy like a 40 delta call. Hold on one sec. I'll tell you exactly what you should look at. Option chipper. Let's buy something like this. 340 calls. I mean, I would do something like that. Where I could pay 8 against 310 on the stock. November 16. I got to put the new check. The November 16 340 calls. Hold on one sec. Let me see if I can. I'm switching over. Hopefully, yes. November 16 340 calls. There's 780. I'm on tape delay on this particular screen, but that's cool. I'd pay $8 against 310 stock. All right, and then if my scenario is right. If my thesis is right, see, I definitely worked the word thesis into this whole thing, right, Mike? You can see that, right? Are you impressed?
Very good. Technology's picking up big time.
I'm gonna start using suite pretty soon. SUITE. That'll be another one. Yeah. So I think you want to evade something because I think if my thesis is right, is that I don't think you're out of this volatility storm, for lack of a better word. I think you're going to get a chance to sell the front month stuff, like next week's stuff, or November 9 stuff at inflated levels. So yes, Sunil, great question. Pay 8, sell 310 stocks, something like that. Do it on your prices. It may come in. Look, if we rally, it may get even better. Okay, and you may get a little bit more on the stock, a little bit less on the options because the people be dive bombing out of this stuff. So yes, to your point, I pay 8 against 310 on the stock, and then if we get any type of sell-off in the thing, like it traded down, it filled the gap this morning. It fulfilled that. It may trade higher. But if we do get a pullback, somewhere between, we did high 323 this morning, I think. 321, 252 off this low, 253, what's that, 68.34, 287-ish in the stock. I think you're able to sell some puts at real nice levels. So you could wind up legging into that thing at a real great price, legging into that variance swap at a real great price, at that 25 delta put, 25 delta call, 25 delta put, taking in that skew. It's gotten cheaper. It's obviously come in a lot in the last 2 weeks, 3 weeks, and rightfully so. But I still think you can play it. I still think it's there, and it's worked. 8-9 weeks in a row. So yes, 340 call, November 16 expiration, pay $8, sell stock at 310. And obviously with the caveat, you got to size it up right. It's a 60 volatility thing. It's a $300 stock. That's, it's 180. If you're doing a $270 spider, it's 54. So it's roughly one third of your spider position. If you're a 50 lot guy in the spiders, 17, 16, 17 in here. Okay. Is that it? Any other questions?
Yes. One big question, but hang on.